REITs crashed over the past year because of one primary reason, and it's rising interest rates. The market fears that the surge in interest rates is going to cause REIT cash flows to drop and their asset values to collapse, and as a result it has repriced the entire REIT market 30% lower. And that's just the average of the sector. There are a lot of individual REITs that are down closer to 50%, 60% or even 70% in the most extreme cases. But what this also means is that eventually, as interest rates return lower, we could see the share prices of many of these REITs soar in value. If your stock is down 50% because of the surge in interest rates, then a return to lower interest rate could essentially result in a doubling of your share price as it returns where it used to be. That's a very big opportunity if, like me, you think that interest rates are going to return to lower levels in the coming years. It's worth remembering here that interest rates really surged because of the high inflation. But this inflation is now slowly getting back under control. A lot of it was caused by temporary factors of the pandemic, supply chain issues, Russia's invasion of Ukraine. But according to Trueflation, which takes the government data and adjusts it based on real-time factors, today's inflation is already down to 2.5%. That means that we are already very close to the 2% target of the Fed, and I think that as we cross below it and the economy dips into a recession, the Fed is eventually going to turn to stimulating the economy, cutting rates just like it has done in the past. With that, some REITs could experience very significant upside in the coming years as interest rates return lower, but which one are the best to buy today? Hey everyone, this is Yursi. I run a small investment firm that specializes in REIT investing, and in today's video I want to talk to you about two specific REITs that I think could double in value in the coming years as interest rates return to lower levels. But before I get into it, I want to remind you that the 2-week free trial for my REIT newsletter is still active, so if you want to access my entire real money portfolio, just click the first link in the description of this video. So the first REIT I want to discuss here is called Safehold, ticker symbol SAFE. I think that this is really the king of bets on lower interest rates, and this is because it specializes in ground leases, which are very sensitive to interest rate movements. In a ground lease, the landlord owns the land and it leases it to a building owner, typically on a very long-term basis of up to 99 years with smaller fixed rent escalations. And so as a result, this is typically seen as a very long-term duration bond, and as a result, they are very sensitive to interest rates. This is well reflective in Safehold's performance over the past year. It's down about 75% since the beginning of 2022, which is one of the worst performances in the entire REIT sector. The market has essentially run away as if Safehold was facing an existential crisis, because in a world of 5, 6, 7% interest rates, it's just a tough sell to convince someone to buy a ground lease at a 4% cap rate. But here's why I really like this company as a bet on lower interest rates. The first reason is that even if interest rates remain higher for a long time to come, the company should be just fine. Its average debt maturity is 24 years, it's really long, it has no debt maturities for many years to come, and meanwhile its rents keep on increasing by about 2% per year, and it also has some CPI lookbacks which would allow it to grow its rents even faster in the coming years. But if interest rates now suddenly start falling, we could see a very rapid recovery in the share price of the company. Its fundamentals have remained strong and its cash flow has kept on rising because the debt maturities are so long, but because interest rates surged, it really affected its market sentiment. I think that even if we see interest rates drop back to just halfway of where they used to be, we could see a doubling of the share price, because even that would price it at a large discount to where it used to be. Overall, the company is doing really well from an operational standpoint. Its cash flow keeps on growing steadily. It's not materially impacted by the rising interest rates from a fundamental perspective, but it has massively impacted its market sentiment to the downside as interest rates rose. But we could now see the opposite in the coming years, and this is why I'm buying the stock. It's also worth noting that the CEO and the director of the company recently bought about $500,000 worth of shares in open market transactions, and that's despite already having a lot of equity in the game, and so clearly they also think that the share price is undervalued. Sorry to interrupt you for a second. Could you please like this video? It really helped me a lot to grow this channel. Thanks a lot. Then the second company that I think is a great bet on lower interest rates is called Uniti Group, ticker symbol UNIT. Unit is a good bet on lower interest rates because of another reason. It's heavily overleveraged overleveraged, and it worries the market that it may have to face bankruptcy if interest rates remain at such high levels. As a result, it has priced the company at about 4 times cash flow, which is exceptionally low for a REIT that owns a portfolio of fiber infrastructure that generates steady and predictable cash flow. But if you now remove the high interest rates, the company will be in a much better position to handle its debt load, and removing this concern alone could lead to a doubling of the share price. Just last year, there were rumors of a potential buyout of the company at about $15 per share, and yet today it's priced at less than a third of that. Do I think that the share price is returning to $15 anytime soon? Not really. But do I think that it could return to about $10? I really think so. I mean, even that would price it at a large discount to its net asset value and a low cash flow multiple. And I really like the risk to reward here, because despite facing very significant risks, the company has managed to push all its debt maturities until 2027, and today it retains a lot of cash flow to deleverage organically. Therefore, I don't really view this as a binary outcome. I think that if interest rates remain high, the company probably has limited upside, it's going to keep facing significant risks, but I still think that the chances of a bankruptcy is relatively small. On the flip side, if now we see a return to lower interest rates, we could see a very rapid recovery in the company's share price as the market reassesses the risk profile of the company. In the meantime, you also earn a 13% dividend yield, which according to the management is sustainable for now. And it's also worth noting that again here the management has been buying shares. The CEO recently made a nearly $1 million purchase in the open market. So again, clearly they think that the company is undervalued. So these are two REITs that I think will greatly benefit from an eventual return to lower interest rates. I of course cannot predict if it's going to happen over the next 6 months or 12 months or 2 years, but I think that it's quite likely to eventually happen. And the nice thing here is that time is on our side, because these REITs still enjoy growing cash flow today, and eventually I also expect significant upside. At High Yield Landlord, we've structured our portfolio to greatly benefit from an eventual return to lower interest rates, and if you want to access my entire portfolio, feel free to join my REIT newsletter, High Yield Landlord, for a 2-week free trial. I'll put a link somewhere in the description of this video. And again, if you could like this video, that would really help me a lot. Thank you very much, and see you at my next one. Bye bye.